Learn these 5 key elements, and you will know how to build and maintain a high credit score, period. 35% of your credit score is your ability to pay your bills on time. Think about that. 35%. You can't miss a payment. If you miss one payment, if you're late one time on a bill that is reported to the credit bureaus that counts for something on your credit, you will drop. Your credit score will drop just from missing one payment. Just one. Just one. So you have to make sure that you stay on top of your bills and make sure you pay them off in a timely manner. So if you have to, why not set up auto pay, some kind of auto payment system on your bills? That could be either through the actual company itself, if they give you some kind of way where you can, some kind of option online to pay your bills and it will come right out of your account every month or every time you choose. Why not do it? Or you can just do it an old school way. Write it down on the calendar. Write down the deadline of that particular bill on the calendar and make sure you pay it off before the deadline, or even on the deadline. It'll be on time. All right. I'm pretty sure a lot of bills have maybe a 5-day grace period, like car payments, for example. I think mine anyway, my car payment, there's like a 5-day grace period after the due date, where if you pay your bill within those 5 days, you'll still be considered on time. So they won't report you to the credit bureaus as being late. That's what you don't want. You do not want that. Not even one time. Make sure you are paying all your bills on time. That one late payment can send your credit score down a lot. You don't want that. Major key element to your FICO credit score number 2, which is something that's not normally talked about, which is your credit utilization. Your credit utilization is 30% of your credit score. This shows how much of your credit you are actually using. For example, if you have $1,000 credit card and you use $500 of that credit card, that means you have a 50% credit utilization percentage. You want to try to keep that percentage at 30% or lower. They say to use 30% as that baseline, that limit in your head. You want to keep it there or lower, preferably as low as you can, like 10%, 5%, or even at 0. So you'll have no balance. So the higher your credit utilization percentage is, the lower that your credit score can go. Once you start going above 30, when you get to using 50%, 70%, 80%, or 100% of your credit, which is maxed out, your credit score can go a lot lower. Your credit score can drop like a rock. Knowing how to control your credit utilization is so powerful that if you know what you're doing, you could boost your credit score by 30, 40, 50, maybe even 60 points or more if you know what you're doing. How? Easy. If you have a credit card that is, let's say it has a limit of $1,000 and you max it out, or you almost max it out, but you have it at about, let's say out of 1,000 you have $800 that you used already, so now you're at 80% utilization. But before the statement date for that card, the statement date is not the due date, but the statement date is a date that the bank will report your credit activity to the credit bureaus. So if you pay off that $800 down to 0 before the statement date, or even pay it down to where you have a 10% utilization, 20% utilization, 30% utilization, then your credit score will shoot up when that bank reports that you paid that card off to the credit bureaus, because you're not maxing out anymore. You're not using that same high utilization anymore over to the next billing cycle. So when the credit bureaus take your activity and show that you paid off that card near or in full, your score will shoot up a lot of points. Try it, and let me know what happened. Let me know how far your score went up if you don't believe me. Another key element that makes up your FICO credit score is your credit mix. It makes up 10% of your credit score, and all it is the different types of credit that you have on your credit report. It could be your mortgages, it could be your car note, it could also be that cell phone that you just bought. All of that accounts for different types of credit that goes on your credit report. Maintaining a different mix of credit demonstrates that you could handle multiple types of loans and still have good credit. Two types of credit that they like to talk about a lot is called installment credit and revolving credit. Installment credit are the type of loans like your mortgage loans, your student loans, your car notes, and personal loans. All of those loans have a certain date where it has to be paid every month with a fixed payment. Revolving credit, on the other hand, are a type of accounts that are kind of like your credit cards and your home equity lines of credit and your personal lines of credit, where you're allowed to use a certain amount of money and you can use it whenever you feel like it. And you only pay when you start using it. And you have a minimum payment that you can pay every month. And you can keep using that money that they give you as long as you pay back the money. But with an installment loan, you get all the money up front, and as soon as you get it, you have to pay it back on that certain date every month. And after you're done paying it, that's over. It's over. The money you paid back is back to the bank, and you're done with it. But with a revolving account, like the credit card, you can keep paying it off, and as long as you pay it off and you're in good standing, you're allowed to keep using the money. So it just stands to reason that if you can show on your credit report that you can handle revolving accounts and installment accounts, like if you have a mix of uh, car loans, a mortgage, a couple of credit cards, maybe a home equity line of credit, which is a HELOC, if you show you can pay all these different types of accounts and pay them all off in good standing and on time, then your next creditor or lender who you want to get something from, like some more money or another credit card, when they see that, when they see you can handle all those different accounts well, then they'll be more inclined to give you the next account that you want. And like I said, credit cards are the most common type of revolving accounts that you have on your credit report. The next key element that affects your FICO credit score is your credit age, and it affects 15% of your credit score. A high credit age reflects well on your credit report because it shows the creditors and lenders that you have a lot of experience handling your credit. While if your credit age is relatively, younger, then you're not as experienced as someone who has been able to hold down a certain amount of accounts very well and paying them on time. So think about that. If you have a few different accounts on your credit report and you've been having it in good standing and you've had them for 10 years, 15 years or more, a lender or creditor will look at that and think favorably of you and will want to do business with you, as opposed to somebody who just got new credit and they haven't had that many accounts and their accounts are only a year or two old. Who are they going to want to do business with? The person with less experience or the one with more experience? Think about that. So you probably have a car you've been paying off for the last 5 years, but if you've been paying it off every month on time without fail, I know everybody hates car notes, but if you've been paying it off every month on time, then you'll look great for the next time if you want a new car or anything else you want. This is part of the reason why when you're just starting to get credit as a young person, you may not have as high as a credit score as somebody older who's had credit for a much longer amount of time. The moral of the story of credit age is keep paying your bills on time for a long time, and you can't go wrong. Another key element that makes up 10% of your FICO credit score is new credit. Every time you go get a new or used car, or you get a mortgage for a new home, you open up a new utility for your house, like maybe cable, or get a new phone, anything like that, you're applying for new credit. It's not just when you try to open up a new credit card. All of those count for new credit. And what happens is when you apply for new credit, you get what's called a hard credit check against your credit, because those different companies and any new lenders want to check your credit to see if they want to do business with you. And what will show up on your credit report is called a credit inquiry or credit inquiry, however you want to pronounce it. Doesn't matter, it's the same thing. I say whatever comes out of my mouth. Applying for new credit can affect you negatively and positively. It can affect you negatively because it can actually affect your credit age, because you're lowering your overall credit age on your credit profile. And those new credit inquiries will also lower your credit score a couple of points, but new credit normally only stays in your credit report for about 2 years. Now, with all of that being said about getting new credit, don't be afraid of going out and getting new credit if you need it, but just be responsible and make sure you pay those bills on time. Here, what you see on the screen is the FICO score ranges. Now you got 580 and less, which is poor. 580 is 669 is fair. 670 to 739 is good. 740 to 799 is very good. And 800 plus up to 850 is exceptional. You want to have your score as high as you can, of course. But if you're in the good to exceptional range, you should be able to get approved for most of the things you want. But the higher the score, the better. Now, if you click on this video you see on the screen, I'll show you how I was able to get a $30,000 Bank of America credit card, and my score was pretty high at the time. So go check it out.